Have you ever wondered what an at-the-money vertical portfolio actually looks like? When you're trading debit spreads and you're buying at-the-money verticals, or you're looking to buy vertical spreads, what does that portfolio actually look like? You might have seen some portfolios, you get some ideas and you get the techniques behind doing a class or workshop. But from a portfolio standpoint, how should it actually look? And it may actually look different for different people depending on what you're doing and the risk tolerances that you have. But in this video, I want to share with you a little insight on how most people's portfolio could be structured when it comes to buying at the money vertical spreads. Now, if you're brand new here, I'm Sasha, the options coach. And one of the last things we just did in our class and workshop was this at the money vertical debit spread 50-50 coin flip strategy. That's what I like to call it, at least, because you're risking one to make one. That's how these spreads are constructed. Now, I've done a lot of coaching over the years with this spread. I find this is one of the things that really ramps people's up in terms of knowledge base and actually getting them to profitability, because it makes them think differently in terms of trading. And what this spread is, if you've never heard of it before, is it basically has a risk one to make one scenario. So what you're doing here is, when you create a vertical spread like this, okay, what's happening is you might risk 100 to make 100. And now when you go in and let's say you start losing, well, the most you could lose is 100. You could basically coin flip the heck out of these things. Risk 100, make 100, risk 100, make 100. So in all aspects, if you do, let's say 50 million trades, you should be roughly breaking even, less commissions, slippage, and that kind of thing. But in general, you've got a risk 100 to make 100. Now, what most people will do is they will jack up the number of contracts that they do in this case, and they might say, okay, I'm going to risk $20,000 to make $20,000. And then, yes, of course, that could work out really well and fantastic. But the thing is this is where the danger lies. Instead, what we want to look at in these things is look to spread capital in different zones and spots. And this is kind of what we did in this class. By the way, if you want some insight on this class, just go ahead and shoot me a message, write me a note, and be happy to give you some more insight about some of the classes that we do. All right, so when we go in and look at a portfolio, here's kind of what that portfolio might actually look like. So this is one of the portfolios. This is the 50-50 at the money vertical spreads portfolio here that I did with this class, just to give you a little insight and hey, how can we structure it and do it? And what you'll find is a lot of these trades, they're not really big trades. They're basically doing like one contract at a time, one contract, popping different contracts, risking only $50, $95, $60, $25, $45, $55. And yes, it's not a huge fortune or anything like that. But what it does is it brings some revenue here. You can see some of them are winners. Some of them over here are losers, in a total of $481 right now profitable. And already we've taken some off already for profit. So the point is that you're looking at spreading capital in different zones, different areas, because if you go in and concentrate a lot of risk in one spot, so think of it like this, like let's say you go in and you look to hide a lot of your money or capital. Well, what a lot of people will do is say, okay, I've got a safe over here. So here is kind of your safe and lock, and nobody can get in it, or so you say. But what happens is, like, when you get some of those bank robbers, right, in those movies like the Fast and the Furious, or Ocean's 11, Ocean's 12, and that kind of thing, they go in and break into the safe. That is not a smart move because it can happen. Something gets damaged with that safe. You don't put all your money in one spot. So what we want to do when it comes to trading is we want to go in and spread our capital in different zones and areas. So this way, if one person grabs part of that money, let's say they grab this one piece, well, the rest of it is more protected. Even if they grab 3 of those pieces and they find 3 hiding spots, well, we've got a lot of other stuff left over and your money is still safe, at least 70% of it. Yes, the other 30% is gone, but 70% of it is still safe. But this is the danger here, is because most people, what they're actually doing is they're concentrating their risk all in this one spot, in this one area. And then when they do this, that's the problem. They go into big spreads thinking, hey, I'm going to win this one. I'm going to go in and it's going to work. Why? Because I went in and I saw the technicals, because I saw the chart over here on this thing, because of the moving average, because of the Bollinger Bands, the Keltner channels, whatever the case is, whatever you're using, volume profile, it doesn't matter what it is. You think and assume your edge or success right now is higher because of the technicals that you saw. Maybe the fundamentals, the news, the whatever, the reasoning, it doesn't matter. The point is that when you go in and put on this trade, if you concentrate too much risk, if you're wrong, now that's one big trade. waiting for a disaster to blow up. So my point here is that learn to spread money and capital. Learn to go in and, diversify in different zones, different spots on different days. This way it can alleviate some trouble. Now, we covered a lot of other things in this class, as far as, let's say, even executing the trade, how to do it, some price checks, and many other factors. So anyways, highly encourage you to check this out. If you're interested, just shoot me a message or a note down below this, or really the best thing, go on our website and shoot me a message there, because that way I can interact with you and give you more details. But anyway, I just want to show you how this portfolio gets structured when you're looking at the money vertical spreads, because when you go in and set these things up, even let's just pull up some things like here, like QCOM. And you can see I'm risking 45 to possibly make 55. Another one that we've got is, let's say, JP Morgan, also a loser right now. Okay, and this one we're losing about $17, but we're risking 150 to maybe make 100. Here's maybe Lyft or PLTR. So LYFT. You can see this one's kind of breaking even though right now it says like it's making some money, but that is a bad read and not really correct. Here's PLTR, same issue that we're showing. How about Walmart? This one's in the profitability zone. It says it's $35 profitable. It's probably only like $15 profitable, because again, we are after hours right now. Let's look at Eli Lilly, if that one actually will work too. This one's a little bit more natural, but again, the profit is a little misread, but it's not quite there in the safe zone, but it's kind of getting there. IBM, let's take one last peek. But the point is we're risking, let's say, 225 to maybe make 275, and this one's starting to get profitable. Again, a little misread, probably only about $25 profitable right now instead of the 48 it's showing. But this is what I want to show you, is that we've got different portfolio constructions all over the place. And yeah, we're leaning a little bit bullish. In total, our delta's 51, but we do have some bearish things in the mix in there. We've got some bullish things in the mix. So there's some bearish stuff, there's some bullish stuff. And overall, this is what we've got from a portfolio basis. Hope that helps. Hope it gives you some insight. There's a lot to learn here. And if you're interested in the class, shoot me a message on our website. That's probably the best way. You can also text me. I leave my phone number on there, unlike a lot of other companies and corporations. So hope that helps. Reach out, learn some stuff, and hope to see you in the next one. All right, take care.